Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. First question is from Bill. It says, if I take a more income first and growth second approach, but interest rates are going to continue to go down, won't that affect my income? Bill, great question. With interest rates coming down, very relevant. And it's possible, but it's also possible to take an income first, approach that helps minimize the likelihood of that happening. And here's why. Yes, if you got into, let's say, a 1-year certificate of deposit, that certificate of deposit, Bill, is going to come due in a year. And it's probably going to renew at a lower interest rate. And then it's going to come due another year later, Bill, and then it's going to, at a lower rate even then. But if you know rates are going to come down, you could lock into longer term things that potentially are as long term as the rest of your life, which means that when interest rates go down, your income doesn't have to go down, because on most bonds or preferreds or even common stocks, the income that gets paid, be it an interest payment or a dividend payment, is stated as a dollar amount. It's a dollar amount per share. So if interest rates go down, you're still getting the dollar amount per share because you've invested before the interest rates went down. Now, if the actual investment drops in value, your income doesn't change, because again, you're getting a dollar amount per share. So the beauty about taking income first, growth second approach is that if you know rates are going to keep going down for a while, you can make that transition from being total return focused, irrespective of where it comes from, to an income first, growth second approach. And you can insulate yourself from that potential decrease in income. But even more important in some ways is you insulate yourself from drops in value of the stocks and bonds, right? Yeah, they'll drop in value, but your income in most cases doesn't change. So imagine if drops on paper, yeah, your net worth is down, but the income that's being paid out to you doesn't change. So think about that rental analogy, right? Real estate can go up in value, real estate can go down in value, but if you have a credit-worthy tenant in there that's paying you a fixed rent payment, then your rental income doesn't change regardless of what happens to the value of the rental property. Think of investing in a income first, growth second approach as being very much like that, Bill. So I hope that analogy helps. Let me give you a more concrete example of how this works in practice. Consider a portfolio of dividend aristocrat stocks. These are companies that have increased their dividends for at least 25 consecutive years. When you own shares in these businesses, you essentially participate with companies that have demonstrated a commitment to maintaining and growing their dividend payments through various economic cycles, including periods of decreasing interest rates. Think about companies like Johnson & Johnson, Procter & Gamble, or Coca-Cola. These are businesses that have raised their dividends annually for decades, which means retirees who owned these stocks 20 years ago have seen their income grow substantially over time, completely independent of what interest rates were doing in the broader economy. Now, it's also worth considering a laddered bond approach where fixed income portions of your portfolio, instead of putting all of your money into bonds that mature at the same time, you kind of stagger them, some 2 years out, 5 years out, 10 years out, so that this way only a portion of your bond portfolio comes due in any given year, reducing the impact of falling interest rates on your overall income stream. Another strategy worth exploring is preferred securities, which typically offer higher yields than traditional bonds, and others, they often have very long maturities, or even are perpetual in nature, right? So they can be excellent income generators that are less sensitive to short-term interest rate movements. Remember, Bill, the key is to a successful income investing strategy in retirement isn't chasing highest yields today. It's about building a diversified income stream that can provide reliable and potentially even growing income over time. By structuring your portfolio with this income first mindset, you're positioning yourself to enjoy retirement with more confidence and less worry about what the Federal Reserve might do next month or next year. Okay, so a great question, Bill. If you'd like to send in your question, you can do so. You can email it to poolelock@poolelock.com. We'll go on to our second question from Jane. She says, it seems most financial advisors tend to be favoring ETFs over mutual funds and individual securities too. Why is that? All right, here we go. Let's expand on why many financial advisors prefer ETFs over mutual funds and individual securities, especially when considering income-focused retirement investments with reduced risk and volatility. So Jane, the prevailing preference for ETFs among financial advisors often boils down to efficiency, specifically the ease of portfolio management. Many advisors today operate under, what some call the disease of ease, where assembling a portfolio, a diversified portfolio using ETFs is quick and requires minimal ongoing management. Instead of selecting and monitoring dozens of individual stocks and bonds, which demands extensive research and time, advisors can construct a diversified portfolio with just a handful of ETFs in a matter of moments. However, this convenience comes with trade-offs. ETFs are typically passively managed, meaning they track an index and do not involve active stock picking or bond selections. For advisors, this approach reduces the need for constant monitoring and trading, allowing them to focus more on client relationships and financial planning. Now, is this laziness a bad thing? Well, not necessarily. For smaller independent financial advisors who may lack the resources or expertise for intensive money management, outsourcing to ETFs can be a pragmatic choice. It allows them to provide diversified investment solutions while still, dedicating time to client needs and financial planning strategies. However, there's a nuance here. The most astute advisors recognize the value of integrating active management or actively managed individual security portfolios alongside ETFs. Now, this hybrid approach combines the benefits of passive ETF investing with the potential for higher returns and customized income strategies offered by actively managed portfolios. It's about leveraging the strengths of both worlds, efficient ETF management and specialized security selection, to optimize client outcomes, especially for those nearing retirement who prioritize income stability and reduced portfolio volatility. Now, Jane, ultimately the choice between ETFs, mutual funds, and individual securities hinges on your specific financial goals, risk tolerance, and the level of involvement you desire from your advisor. Each option has its merits, but understanding these nuances can help you and your advisor craft a strategy that best aligns with your retirement objectives. So, you have to kind of zero in on it with them, right? Hey, great question. And it's crucial to explore these, considerations when planning for your financial future. So, if you would like to send in your question, you can do so. You can email it to poolelock@poolelock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.